Welcome, everyone. My name is Josh Weiss. I'm the head of sales for Utila. This is episode 5 of our Stablecoin Builder Series. This webinar in general is just a monthly live session for founders, entrepreneurs, operators who are building products in the stablecoin space, which is hosted by Utila. We cover topics for projects at really every stage of growth and what we feel are the most pertinent and pressing topics in the stablecoin arena. We run these sessions to just help the stablecoin ecosystem grow and learn by bringing in awesome people like the 5 other panelists we have today to really just tackle and talk about real infrastructure challenges that we see in the industry. Super quick intro about Utila. For those who are new, Utila provides fintechs, banks, and other enterprises with infrastructure to build and manage stablecoin and digital asset operations. We serve around 300 institutions today across payments, treasury, trading, and much more, and we help secure more than 25 billion in monthly volume. As far as today's topic, stablecoin yields, which we really feel strongly is one of the biggest opportunities opening up for builders right now. There's many institutions today who are sitting on idle stablecoin balances, right? So whether it's settlement float, treasury reserves, working capital, et cetera. And because of that, these types of players are increasingly looking for ways to be productive with that idle capital and really put it to work. It's a massive opportunity for builders in the space. And today we're going to be digging into how to build yield into your stablecoin products. A few of the things we'll cover just to give a quick agenda. Why now is the time institutional yield is gaining momentum. The whole infrastructure stack, right? Things like on-chain lending, vault strategies, yield aggregation, and much more. How to offer yield under institutional grade governance and controls, trade-offs between CeFi and DeFi, and just what this means for your products and business models and the opportunities that are available in the market today. Just super quick housekeeping. Feel free to drop all of your questions, any questions throughout the session in the chat. We'll do our best to look at everything, and at the end, we'll try to leave about 5 to 10 minutes for Q&A. So with that said, maybe I'll just quickly pass it off to the speakers. I know there's 5 of us, and maybe just please be a little bit brief, just a quick intro on yourselves, your companies, and we can get going from there. Elbruz, you're first on my screen, so you want to kick it off? And then we have
Josh.
Aidan, Sebastian, and Alexandra.
All right, sounds good. Hey, Josh. Hi, guys. Good to be here. Thanks for inviting me. I'm Elbruz. I work across payments, stablecoins, and fintech, mostly focused on how the money moves, actually. Be an operator, investor myself, and now advising banks, neobanks, fintechs, and their exposure to stablecoin infra. I'll bring more of a flow and distribution perspective today.
Cool. Yeah, can happen next. Thanks, Josh. Good to see you all, as always. I'm Aidan from Gauntlet. Quick TLDR on Gauntlet. So we're a quant firm, started back in 2018. I would say for the first 5 to 6 years, the core business was really focused around providing risk management and optimization services to different DeFi protocols. Over the years, been super fortunate to kind of work with and manage risk for a lot of the largest players in the space, particularly a lot of the prominent borrowing and lending protocols on chain. And then over the past 2-ish years, the business has expanded quite a bit, and we've grown to become one of the prominent risk curators in the industry as well. I'm sure most people, well, everyone on this panel and probably most people listening are familiar with that term at this point, but just in case anyone is not, basically all that means is we manage and run these on-chain vaults throughout DeFi. The vaults are basically just non-custodial structured yield products. And in our case, those are deploying strategies predominantly across lending and credit in places like Morpho, who you'll hear from in a second, but also like derivatives and perpetuals, trading strategies, RWA strategies, and a couple others as well.
Hey everyone, my name is Alim Khamisa. I lead all things DeFi at Optimism. Optimism, I think most are probably aware, inventors of the optimistic rollup and the OP stack. We're very focused on bringing enterprises on chain, and we've got a new offering around OP Enterprise. Yeah, excited to be here today and contribute to the discussion.
Hi everyone, my name is Sebastian. I lead all things institutional at Yield.xyz. Yield.xyz, we're essentially an API infrastructure layer where we aggregate yield opportunities on chain, and we do that across the entire stack: native staking, liquid staking, restaking, and DeFi. We work with 30 different staking providers, 45 DeFi protocols, and support 75 chains. And the sole purpose really is to act as the sole integration partner that any sort of wallet, exchange, neobank, or custodian platform would need to go to market with a fully featured earn product in a matter of a couple of weeks instead of months of individual integrations with protocols, vaults, etc.
Hi, everyone. Good to see all the familiar faces here. My name is Alex from Morpho. Morpho, in short, Morpho is a lending protocol, and essentially, this is the place where institutions could generate yield. We work with the whole ecosystem, starting from asset issuers who could be stablecoin issuers, RWAs. It could be DeFi funds who are more on the borrow side, but also looking to lend to generate yield. However, the latest focus is really to work more on the B2B side of things. So there are a lot of earn integrations and credit integrations that are powered by Morpho. And when I say earn integrations, it would be a yield product within Coinbase. It would be a yield product within wallet, something like Ledger. And on the credit side, Bitcoin-backed loan products with Coinbase is probably the largest example that we have today.
All right, cool. Thanks, everyone. So maybe let's start with more of a macro view and sort of the market dynamics, like the why now. So to start, I guess, and feel free to just jump in and obviously build off of each other. How did the impact of high global interest rates, the rise of tokenized treasuries, RWAs, and DeFi maturity sort of create this perfect storm where now is the right time for stablecoin yield?
I mean, I can probably start things off. Maybe I'll take more of like the DeFi maturity piece. I think, it's been an interesting time recently. I think it's the first time we've seen like this decoupling between like price action and adoption. Like obviously prices are at like super cycle lows, but I think everyone on this call can probably attest to the fact that like adoption, particularly on the yield and stablecoin side, continues to be directly up and to the right. And I think what that tells us is that for the first time, and I hate saying this because it's kind of been a meme in crypto in the past, but like for the first time, this cycle is like very institutionally driven as opposed to retail driven. I think in the past, when the cycles have been more retail driven, the second prices go down, you just see kind of adoption drop off a cliff, which is just, anecdotally and, from the announcement, you probably see just not what's happening here. And I think the reason this is so important on the stablecoin yield side is because as you see more like fintechs, institutions, et cetera, integrating like on-chain primitives, DeFi products, and distributing those to their users, particularly as Alex mentioned around things like crypto-backed loans. What that is doing is driving like long-term structural, in the crypto-backed loan example, like borrowing demand to these on-chain primitives that from users who traditionally would not be accessing it. And in turn, that is allowing like the supply side TVL to grow without basically the yield compressing, because now there is this like chasm of borrowing demand that's opened up. And so, yeah, the supply side can grow, the yield is not compressed, and then also it's not reliant on incentives to kind of subsidize rates and keep those competitive, which I think has been super interesting and a dynamic that's been pretty unique to this cycle, and definitely something that I'm sure we've all experienced and are very bullish on that continuing.
Yeah, I agree. I think one of the things that we are seeing when we're talking to banks and other fintechs is that they consider stablecoin as an infrastructure layer now, which means that it's a volume business and they would like to consume more volume. The main challenge for them is, I think, because yield is a future and the flow is the business for them, so they're looking for regulated distribution methods so they can actually tap into this class. So I think winners won't be the best protocols. It will be the ones that are embedded into banks and fintechs. That's where the volume is, into payment flows. And we always talk about stablecoin use cases, whether it's B2B payments, treasury, FX, etc. But that's not DeFi loops. That's actually real business. And I think most of these institutions want to see it somehow tied to it. So I think, and if you want real volume, you need to go regulated distribution method. I think that's the missing link right now that we are kind of venturing into this phase.
Just to add to that, I think this cycle is very different from previous cycles. I think it's really the institutional cycle, and I think that there's three key drivers essentially driving that. So since post 2022, we just saw real rates make yield meaningful again, right, with the rise of inflation and interest rates. Then we saw tokenized treasuries give on-chain yield a credible real-world anchor, right? And finally, DeFi protocols, they matured enough so that institutions could actually trust them. And I think these drivers have really pushed or attracted institutions into our ecosystem. And the beauty of what we do at Yield.xyz is since we aggregate all of these different protocols and chains, we give institutions access to yield, be it RWAs or in the form of vaults, you name it.
I can quickly chime in as well. I think the scale of DeFi, just in general, more liquid markets, I think is really an enabling factor for institutions. I think as like interest rates, like looking back at the macro, interest rates historically over the last several years have started, have been hovering around the 4 or 5% range. There's been this desire for yield that at least beats that baseline, treasury yield rate. And for that reason, I think like stablecoin yield has become ever more important, but also looking at the yield bearing side, like yield bearing stables, I think is now, there's definitely a focus on that as well as institutions seek yields that beat, that baseline US Treasury yield rate. So I think as like markets become more liquid on chain, DeFi protocols are definitely maturing. Many are becoming more Lindy, having been around for a long enough time and being battle tested enough. And now with this new kind of focus on the yield bearing side of stables, I think it's kind of the perfect confluence for institutions to engage on chain.
Maybe to add last point to everyone that the guys already mentioned, yes, definitely there is one side more concentrated on the yield, but then on the other side, and this is a bit more from the like infra perspective, you need to have certain systems in order to operate with institutional players. They have their own custody solutions, and this is the first cycle where custody can actually interact with DeFi, and there are like embedded operations and certain safety mechanisms that led to deploy capital in DeFi overall. You cannot just connect your browser wallet and expect the billions and trillions to flow into your protocol. So we had to do quite a lot of work into secure these integrations first, and now educate and make sure that we're speaking the same language with all this new capital and new players that are more familiar with TradFi terms, be able to interact with our like crypto native world.
Thanks, Alexandra. Yeah, totally agree. I would say, I think we've really seen a shift from Circle's USDC to more yield bearing alternatives. How would you say today that issuers are competing for liquidity, and do you think that the competition that we see today is sustainable?
All right. I mean, I'm happy to kick things off again. Can give like I'll stay more on like the DeFi perspective in terms of like competing for liquidity on chain. I think, I'm assuming you're getting more of these like yield bearing assets or like synthetic dollar type assets that you see on chain looking for growth. I think the competition and the ones that have done well, and I can give a few examples in a moment, largely are built around the issuers that understand that what is going to allow more capital to flow into their asset is creating like utility and productivity for that asset by integrating it into on-chain primitives. So I think the ones that have done particularly well are ones that have focused on integrations in places like, Aave or Morpho, or like just other on-chain money markets where people can now access leverage on the asset to enable it to be more productive. People have done integrations with protocols like Pendle to enable users who want more predictable returns to access like a fixed rate derivative while still having kind of like the same underlying risk of whatever the basket that underpins the yield for the yield bearing stable is. Or people that have worked with, people like ourselves or other curators to kind of onboard to our vaults and enable us to enable users to access loans that are underwritten from our capital. And again, like get that leverage, get that utility, and either run like looping trades and farm a lot of the attractive spreads that have been present in the DeFi ecosystem, or like other various kinds of carry trades. I think Maple is probably a pretty good example of that. Like I think you look at Syrup USDC and Syrup USDT, and like the growth has been extremely correlated to like all of the different DeFi integrations that they've done, and they, I think, hats off to them for doing a good job with like getting in places like Morpho, Aave, Pendle, launching on new chains to get that distribution. Like what they did with Plasma was a big growth driver for them. And then also going to places like Solana, where you kind of saw a little bit less of that by the time that they were there. And so I think that's kind of been like where the competition is. I think naturally, like, is the competition sustainable? Like, as more people realize that this is the playbook that works, it will become harder to execute, and like the edge of like first mover advantage will erode over time. So I guess we'll see how that plays out. But on the DeFi side, I think, yeah, it's really hard to grow an native on-chain or just a crypto asset if you do not have these integrations that enable excess utility for that asset.
Yeah, maybe from a different point of view, most of the yield is still today circular on DeFi, and I think it's optimized for traders historically, not for CFOs of enterprises and SMEs. So the perspective is quite different when it comes to them, and I think the biggest gap for them still is, in most cases, in certain jurisdictions, still fiat on off ramps, is as simple as it may be. And I think I agree with Aidan that yield will continue to compress, and the bigger shift will be around, how stablecoins are used for payments and other products become available for treasury. That's where I think we'll see volume mattering more than basis points, and I think that's going to be the main shift in the coming years.
Can chime in as well. I think institutions are definitely looking for more sustainable yield sources as relates to yield bearing stables, and I think there's a lot of interesting yield bearing stable models that have emerged that are bringing kind of all weather yield on chain. I look at things like OnRe or Re, bringing reinsurance yield on chain, for example. Daylight is a protocol that's actually bringing excess energy production on chain to power its yield bearing stable. And of course, Maple, and there's many other examples where real world yield is powering these stables. I think that becomes more sustainable versus kind of a lot of the native on-chain yield stables that we're seeing that where they're very exposed to kind of market cyclicality. So I think those models will start to see more of those over time, and I think there'll be more institutional interest on that front.
Just to chime in, the way what we're seeing Yield.xyz is that the market is definitely bifurcating. We have static stable coins that are used for settlements like USDC, but then we have yield-bearing alternatives that are used for capital efficiency. Is the competition sustainable? Well, that depends if the yield source is real, right? Be it protocol revenue, lending spreads, real-world assets like private credit. I think what's not sustainable in our industry is anything that's just subsidized liquidity, right? I think that will be the key challenge.
I guess from the lending protocol perspective, like any competition within the asset issuers is not good, because you always need to have a good collateral asset in order to lend against it. Because essentially, and the way how Morpho works, the lenders are getting paid from the interest that the borrowers are paying on their loan. And there should be a good set of collateral that could sustain good enough borrow rate in order to make lending attractive to lend capital. And then, of course, like there is always blue chip assets, something like Bitcoin and Ethereum. But in reality, in the bear market, those rates are very low. So you have to look for alternatives. And then it would be something like yield bearing stablecoin. Ideally, you are not going very high on the risk curve, but it should be still decent yield of the asset, so it allows to run some like leverage strategies. And if you have a set of like 3-5 good collateral assets within one vault, it could be a pretty compelling case, and the yield on the lender side would outperform the like treasury. But also tokenized treasury could be used as collateral as well and create some sort of floor for the vault. So the lender side would always get the treasury bill plus some premium, because it's still like crypto and tokenized. And of course, you need like all pieces to be here. You need to have a good risk curator who'd be able to underwrite all these assets. You need to have the selection of assets, and then you need also secondary liquidity and all like oracles and all crypto native things. And this is also surprisingly a way for asset issuers to compete, because they need to build the whole infrastructure around the asset itself in order for it to be productive.
Josh, can I squeeze in a question for the panel? I'm just curious about one thing. Yeah. So I think, talking to banks, obviously these guys love ratings, right? So they want to talk about, is that thing rating just like themselves? And I think we have seen platforms like Blue Chip, and others started rating stablecoins. But in most conversations I come across, the question is there a rating system for, the DeFi platforms or DeFi yield? Is there a credit rating system that can actually institutions can really look at it and scale with that? Is that something that, the panel sees as a common challenge in explaining where does yield come from, how the governance works, how liquidity is secured, tokenized, etc. So what do you think about the credit rating system for yield, especially on DeFi?
I think it's important. I think the way a lot of these traditional institutions have just operated is they're just used to that model where like they're looking for the stamp of approval from a trusted third party to say like, hey, this is safe, or like these are the risks that exist. In DeFi, yeah, I'm confident we'll get there, and we were already kind of seeing early signs of that. Like there were players like Credora, who was acquired by Redstone, who did a risk ratings for all the top Morpho vaults. I think like Redstone and them are kind of redoing some of the methodology, and they'll roll out new ratings and updated, reviews shortly. But also like the S&Ps of the world, the Moody's of the world, like they are very much so looking at this stuff and figuring out their own methodologies. I think they see it as a huge opportunity. Especially at this point to provide ratings. And I'm sure, we're actively talking to these guys about ratings on our things. I'm sure everyone else here is, doing something similar. And even beyond like credit product or ratings on like credit type products on chain, like you see things like the token, I forget exactly what it's called, but like the token overview reports that like Blockworks is now putting out that kind of provide something similar, but for like, the protocol tokens of different on-chain protocols, so people can get a better idea of like what the token actually does, like how connected is it to the revenue, like how much rights do you actually have as a token holder, and so you're definitely seeing a big tailwind of just like things like this that I think are propelling us in that direction. So yeah, I think it's only a matter of time before you have like the top players who kind of all of the rest of the industry looks to be like, okay, this is the consensus of like when one either X, Y, or Z says that like this is prime or AAA or whatever, like we can accept that. We're not there yet, but like these things are all very much so happening under the hood, and I imagine I'm always hesitant to say this in crypto because it always takes longer than we think, but I actually am quite optimistic we'll be there on the sooner side.
I can just double click on one kind of part of that, and I completely agree with Aidan. I think there's like a lot of disparate frameworks right now for how to evaluate risk around stablecoins. Moody's, I believe it was just last Tuesday, released their stablecoin rating framework, and it assesses things like credit quality of the reserves that are backing the stablecoin, market value risk, liquidity, operational resilience, technical risk. I think the key things being like the reserve transparency and asset composition. But that seems to be quite a comprehensive framework, and I think we'll see more of those from trusted TradFi organizations that large institutions are quite familiar with. So I think that's a really good start. We need to see more kind of consolidation around a singular framework or maybe one or two. And to Aidan's point, I think that'll take some time, but we're on the right path.
Thank you.
Cool. So I think like building off of this, we've talked about a lot of these newer players already who are getting into the stablecoin game, right? Fintechs, PSPs, banks. It's no secret that everyone in sort of traditional finance and payments is looking at stablecoins for many different use cases. What's one piece of advice that you might give to these players when thinking about launching a stablecoin product or strategy? Maybe we start with you, Elbruz. You asked the last question, and you work with a lot of these financial institutions. So let's start with
you. Walking into a board meeting or a senior leadership meeting, usually there's a lot of FOMO. They want to do things very fast. And my initial starting point is that you always overestimate the change in 2 years, but underestimate the change in 10 years. So you have to basically pick your battles and build a stack that can actually give you a lot of business use cases, not just doing things that just because your competition is doing, or you read an article, or you saw MasterCard acquiring or submitting an intent to acquire BVNK. So I think usually the challenge is there's a knowledge gap in the room. There might be people who get crypto, DeFi, stablecoin side of things, but the decision makers are usually quite distant to the topic. So when they hear about crypto next to stablecoin, they think it's high risk. So I think there's a little bit of an educational curve that we need to go through, and this takes time. And after that, I think it's basically coming down to a business case where they can say that, okay, for example, I think Alexandra mentioned that, you look at custody. Custody is such a term that's misunderstood. Usually what we use is a vault infrastructure methodology. We say that this vault infrastructure can enable you to tap into yield or do, settlements, etc. So it's a little bit of an education initially, but then you boil it down to a business case and show them these are the areas of influence that you can unlock by plugging into, I don't know, no pun intended here, but Utila that can open up different, engagements with you, with partnerships, or you can have very bespoke use cases where if they want to issue a stablecoin, you can actually showcase them to the cost of it, maintenance, regulatory burden of it, etc. So it's usually peeling the onion one by one and understanding their rationale behind it. And usually we come across many debates where if they have a certain capex or opex constraint and they have to pull the trigger towards one initiative or a few initiatives, you're competing against an AI initiative in some part of the organization or international expansion. So I think it's important to embed stablecoin infra play into each business unit, each business case naturally, not artificially, and show them actually it's a capability that can actually unlock many different use cases for you. It takes time, and I think just like any solution sales, you need to find a few champions internally. Compliance is always underestimated. They think they can, because they have a MiCA license, they can start doing stablecoin settlements, which actually requires PSD2, PSD3 compliance. So I think it's more education and getting everybody kind of facing the same problem, and then showing that you don't have to do a huge capex investment to launch multiple business lines with it. It was quite fun, and I think I have to say that when you look at Yield, what we have seen is that most of them don't want to pick vaults manually. They want aggregation. They want simplicity. They don't want to take any risks themselves. They want to see if this is battle tested. And I think the other day in a board meeting, the question was about stablecoin volumes on this, on that. And I think when you look at Yield, it's still seen as a distant item in their mind. They think they can make money with it, but they don't want to lose their jobs because they try to sponsor a Yield project internally. So I think it's very cautious, but you need to invest a lot of time in educating them upfront. Yeah.
I guess to add to that, at Yield.xyz, we work with a lot of fintechs and neobanks. In fact, DO banks, I think they're called DO banks now, decentralized neobanks, where users can hold stable coins in self-custody, and then they have access to a Visa or MasterCard debit card, which they can use to spend their stables. And I think what a lot of these fintechs and neobanks have noticed is that Yield is the new cashback or new form of cashback, right? Where they realize that their users find a 4 to 6% stablecoin yield very attractive, and it's been a very effective way of attracting users to the platform instead of like the more traditional acquisition costs. And they've also realized that it's stickier than having sign-up bonuses, right? So you can really attract users by offering them a higher yield than what they would get through traditional banking rails. We started working with a lot of these neobanks individually, and now we've realized that a lot of the debit card issuers are interested in yield as well. So companies like Reap, Rain are starting to actually delve into DeFi and embed this experience into their stack.
I can chime in quick, and I think I'll take a different perspective. Like when I think about what institutions need to really consider as you're venturing into the stablecoin space, maybe they're launching their own stablecoin. I mean, there's some fundamental things that have to happen just around, hygiene, and they need to be thinking about things like integrations across the stack, right? Like integrations across wallets, with embedded wallet solutions. They need to think about like block explorers, block explorers, token listing sites, on-chain data platforms. So there's a lot of hygiene things that need to happen, and often. Someone talked about the education journey. I think that upfront journey is really important, and we need to front load that with as much education around like what does it take to launch a stablecoin, what does it take to or just participate in the ecosystem, using stablecoins, whether it's for things like settlement or payments or whatever it may be. From a GTM perspective, I think like things like distribution are super key as well. Obviously. There needs to be liquidity across the DeFi ecosystem for the asset to be able to function and actually succeed. But distribution is really important, whether it's through, again, through wallets like Utila or other institutional platforms like large custody providers. There's Fireblocks, there's Copper, Taurus, many others in the pipeline. So I think there's like a very fulsome, kind of like roadmap for how to get to market with a stablecoin if an institution is actually thinking about launching one. That's kind of the angle that I'm taking here. And there are a lot of partners that can help, like, I think Sebastian called out Rain. There's Bridge. There's many others that can make this very turnkey for an institution. But definitely a lot of hygiene things to consider before going to market.
I think they were all like great points, and I also spent quite a lot of time recently working with new stable coins, which comes with its like pros and cons. From the lending market perspective, the biggest thing that is the most valuable with existing stable coins is the network effect. So when you have a new asset issuer and they have USD denominated stable coin, the first question is what is the network? What is the distribution? Why people would pick this USD denominated stablecoin over, let's say, USDC, USDT, or something like Pi USD. And then there are like large budgets in play in order to make people switch this. Like FX is now a big thing as well. You see there are a lot of Euro stable coins. There are like a lot of movements in Latin America. But the number one question from our side is what is the distribution and who's the end user of this? Because sometimes you can have a stable coin geo-specific, but actually stablecoin adoption in that region is not sophisticated enough and it could be too early. So timing and distribution.
Yeah, I mean, I think our conversations on the curator side are probably very similar to a lot of things that Alex is getting at there. I think the one potential pitfall that we see with a lot of like less crypto native counterparties trying to build out their stablecoin strategy is like not zeroing in on what they want, like the objective function of the stablecoin strategy to be, or like what the North Star for them should be. They kind of just want everything and like the whole kitchen sink at once. And what I mean by that is like, is their strategy, like I think they need to be more specific, like, hey, do we want to have our own like white labeled stablecoin issued by someone like Bridge? And then our strategy is to like grow supply and make money off the T-bill reserve yield, right? Or is it like we actually just want to enable stablecoin based financial products for our users in our front end and provide them with the best user experience for those products possible? And if that's the case, then like it's going to be extremely difficult to do that. It's kind of like to Alex's point, if you are going to use your own white label stablecoin that has no network effects on chain, because you can't just throw this on a vault on Morpho and expect there to be yield. Like there is structural demand. I mean, the data is extremely clear. Like there's structural demand or a structural dispreference, I would say, to borrow anything on chain in size that is not USDC or USDT, basically. And so building that out. And obviously, yes, it sounds nice to like, yes, we want our own white labeled stablecoin. We want a Morpho. We want all these borrowers coming in and doing it. But this is not something that you just like, basically just get because you like drew up a business plan. There's a lot that goes into it. I think people don't think about some of the nuances and mechanics. It is not impossible. Like if you do want like your own stablecoin, I think it's out and you want it to like be integrated and used widely within on-chain primitives. There is a certain level of distribution that you as like a fintech or institution need to bring up front. So like ways you can do this is like, yes, create a Morpho vault. And then you can create markets where you can borrow this stablecoin against different assets. However, like you as the institution need to be responsible for that distribution, and probably in most cases initially until there is some network effects and people get comfortable with it on chain. And what that looks like is maybe embedding some kind of crypto-backed loan product into your front end or your UX, where users are borrowing USD against Bitcoin, ETH, or other assets. But on the back end, it is just your native stablecoin that's being leveraged, on like Morpho's infrastructure or something. So I think, yeah, everyone wants like all of the benefits that could potentially come with stablecoins up front, but being more strategic and understanding like what your priorities are based on like what kind of business that you operate is, and then working on some of the other stuff later on instead of just kind of again trying to do the whole kitchen sink at the beginning.
Yeah, I agree. I think one summary I heard was every stablecoin needs a business model, but not every business model needs a stablecoin. Yeah.
So I think thus far there's been a lot of alluding to the theme of, I would say, like yield compression, right? As more of this institutional capital starts to flood into the space, do you think that the double-digit yields that we've seen for so many years in DeFi will vanish, or do you also see a world where that will continue to be a thing and it will coexist?
Yeah, can jump in. I mean, I definitely think that the days of like low risk double digit yields are completely gone. And that's a good thing. That shows maturity in the ecosystem. It shows that more sophisticated capital is coming in. These trades that have ridiculous arbitrages where like your risk is really low, but your return is high are getting closed, which is again a sign of healthy markets. And like I also think like you know, if you're just lending like doing a vanilla yield strategy where like you're supplying capital to a vault that's lending against Bitcoin and ETH in like an over collateralized fashion, you probably do not deserve to be getting 10% yield from that. Like that's kind of an unrealistic expectation. I still think it is possible for sure. Like there's still edge in on-chain yield products to deliver things like double-digit returns. However, I think the complexity of the product needs to be a lot higher than, or the bar for like how complex the product needs to be a lot higher than it used to be, right? And like with that comes trade-offs. Like you probably for a lot of these double-digit yield strategies that do not rely on incentives or subsidies, you need integrations with like multiple chains, multiple protocols. You're tapping into multiple primitives at the same time, and naturally with that, you're increasing the surface area for potential financial or smart contract risk. Um, uh, so I think that's one of it. I mean, like on our end at Gauntlet, I think the one like product that we offer right now that has like consistently been like 12, 13, 14% without any incentives at all is like kind of a perfect example of this happening where we're marrying a lot of primitives together. Basically, we run like a leveraged RWA strategy with Falcon X. They have like an RWA for, basically a basket of loans that they issue to institutional counterparties from their lending desk. We worked with them to set up a market on Morpho where you can post this RWA as collateral, borrow USDC against it. We then take our USDC vaults and actually supply the liquidity for borrowers to actually draw down on. So we're like the lenders on the other side of this as well. And then on top of that, we sit a vault that actually manages like an automated leverage loop using this underlying Morpho market where users will deposit the RWA into the Gauntlet vault. We will post that as collateral on their behalf in the Morpho market, borrow USDC, and then go mint more of this RWA, this credit RWA from Falcon X, and basically just farm the spread between the RWA return profile and the rate at which we're lending USDC to the market. And so things like that, I think like we're tapping into like Morpho on-chain credit protocols. We're using some of our own vault infrastructure for this. Like if you can build these more complex, sophisticated strategies, you can still obtain the yields that we were used to in DeFi. But yeah, I think, and again, it's a good thing that the days of just being able to come in and click like supply USDC to Aave or like a Prime Vault on Morpho and expect double digits those days are definitely gone.
I could jump in. Yeah, completely agree with all those points. I think like structurally, we're going to see DeFi yields kind of continue to compress towards that risk-free rate. I think plus a liquidity premium. There's like always going to be that residual spread, for those willing to take on, the smart contract risk or illiquidity or complexity risk, depending on the type of stablecoin, of course, that we're talking about. I think the point on RWAs is really important. First I should say, yeah, like the days of like 10, 15% yields on stables, on yield bearing stables, whatever is maybe not so sustainable. I think again we'll compress towards that 2 to 4%, getting closer to the US money markets and treasury yields. But yeah, I think like RWAs and the looping strategies are really, really interesting. I think we're going to see more of that start to power a lot of the yield opportunities with stables. So that's like the one area that I'm the most excited about. And, we're seeing things like, like treasuries coming on chain, public credit, private credit, all sorts of other things, including the things I talked about previously, like real world yield from reinsurance or energy or compute. All of that I think will pair together with stables to offer some pretty attractive yield sources.
Maybe to echo on both points from Alim and from Aidan. So essentially, yeah, all the days of 20 plus yield on pure vanilla lending is probably gone, and it is in fact a good thing. This is probably the expectation of actively managed fund, and now there is a lot of infrastructures that bring these actively managed strategies on chain. However, they are transparent and you can see each position, you can see what is the health factor of every position. So in a way, there is a lot more transparency in the way how this yield, pretty much where the yield comes from. However, on the pure vanilla like lending side, again, it all comes down to collateral set. And when we were starting, to see this like rise of lending markets. There was like Bitcoin and Ethereum as the collateral assets. Then there is something like Pendle, some new yield bearing stable coins, and this was the next like onboarding of collateral. Now we are talking about RWAs, and this is something where the yield is not really dependent on the crypto market conditions. So in reality, this collateral should like let us to have more or less balanced approach and more or less realistic expectation on what could be done on the lending side, what is actually sustainable. So you could probably still get pretty good premium over the like T-bill rate or over 4% that more or less could be achieved very easy without taking like any crazy risks on that. But on the long term and on like 30, 90 days average, you would probably still see it under 10%.
So let's maybe move on to another question. Seb, I think that like given your experience at Yield.xyz, it would be great to get your perspective as well for the audience. How do you feel like wallets and fintechs are abstracting away the complexity of DeFi? And I guess in the coming years, do you think that end users are even going to know that they're interacting with smart contracts?
So I think that the end game really is to abstract all of the complexity away. So gas fees, bridges, etc. And we have seen a few of our clients do that successfully, especially the neobank platforms, where with a couple of clicks, you start generating yield on chain almost instantly. I think we will move towards a world where the user won't even know what protocol they're interacting with. It'll just be yield, right? And the neobank will probably label the specific yield strategy around their branding. Let's call it the USDC Prime yield. And I think we're probably going to go towards a world where it's cross-chain as well, right? So capital will be deployed automatically in the backend to maximize the yield of a specific strategy, cross-chain, and I think we can even layer AI on top of that, where we are starting to see AI agents where maybe the neobank platform doesn't even have an interface anymore. You just say, hey, what are the best USDC yields right now? It gives you a list, and then you tell it, hey, please deploy 10K to these 4 strategies, and it'll just do everything automatically for you using APIs.
So I guess, go ahead, Alim. Sorry.
I was just going to say that, yeah, I think like in terms of, adoption and fintechs in general, like those two topics, fintechs tend to hold, the key relationship with a lot of users. And I completely agree. I think the DeFi aspect is going to be completely abstracted away. Fintechs are increasingly becoming like the primary, financial institution relationship with users. So I think like Sebastian might have touched on this earlier, but we're starting to see kind of crypto yield really becoming the new cashback. We see that with often with a lot of card startups in the space, including like EtherFi, for example, that provides a cashback, based on the balances that the user is holding, the transactions. So I think that is going to be pretty important, and offering yields again that beat like the baseline yield on U.S. Treasury rates or bond rates in general, I think is going to create a very sticky mechanism for these fintech products. One thing I wanted to mention was that I think the user experience still needs work. We need to be able to abstract away not just a lot of the Web3 complexity, which is happening with a lot of infrastructure and tooling that's available today, but even assets, right? Like when a user's interacting with a fintech wallet, they don't really want to see 50 different stablecoins. Like they want to see like, hey, one fiat currency, right? Maybe it's USD, maybe it's Euro. And under the hood, the yield strategies can be leveraging a bunch of different stablecoins across a number of different DeFi protocols, across a number of different chains. And a lot of that could be agent driven, right? But at the end of the day, like the simplest, most, kind of like frictionless experience is going to be seeing that one balance. And I could take that balance and I could deposit it into a savings product that's effectively a DeFi vault under the hood that allocates across a number of opportunities. and and that's maybe actively managed or in part managed by agents working within like certain policies. But yeah, I think it's kind of the future.
Yeah, I mean, I agree with Alim, but to a certain extent, the interfacing parties will tend to change in the coming years. So when you talk about agentic payments, there's no user interface for you to actually do that engagement. So when it comes to yield, I think to Seb's point earlier, the user might just be benefiting from the end result, but might necessarily not have the interface with it. And then when it comes to optionality and choosing which yield or vault, etc., on a day-to-day or hourly basis, it might be quite differently optimized. But essentially today, what we are seeing is, to Alexandra's point, when you look at RWA, there are still pockets of inefficiencies that you're unlocking by combining DeFi and TradFi flows. I've seen this in payment financing, for example, trap capital for remittance companies. A huge issue still remains to be, and they are willing to pay significant, let's say, percentage on moving those funds faster. There's a surcharge to it, but they can unlock inefficiencies that way. And there are funds and asset managers investing in those companies providing those type of financial products. But it's kind of like a mullet. On one end, they have a TradFi view. They are talking to these companies, but the source of the fund is actually secured online through protocols and smart contracts. So I think maybe Aidan mentioned this also, the abstraction is the key point for institutions to come in comfortably. If you don't have it, even though retail users might want it, sizable institutions will still hesitate. Without the abstraction, they will not jump in. So I think over the next few years, that will be the main point. Companies who have actually robust risk, governance, compliance, and engagement and balance sheets will actually provide more comfort and confidence for institutions to partner up with them. And I think that's the missing link, because when you talk to a company that does optimized yield for a crypto trader mindset, that doesn't translate to an institution that's actually going to get low risk, low return yield that's comparable to TradFi yields. I think that's the transition we're going through. I always joke about it. Most people do not know how to use a fax machine, an email, and a cloud computing device at the same time. But there's a certain bunch of people on the planet that get these three different worlds. And I think that DeFi and TradFi are going through these motions these days.
So I'm conscious of time here and want to make sure that we get to the audience questions and maybe anticipate a few more. So maybe we can give some quick hits so we try to get to all of them. Sorry in advance if I mispronounce anyone's name. I do that often. So we have Moise. How should institutions balance the strategy of capturing on-platform yield with the reality that users stick with what is most liquid, convenient, and interoperable?
So I think when
go ahead. Sorry, my bad.
Go ahead.
You go.
Okay. I also did a lot of retail crypto stuff during Bitpanda days. So I think when you look at what users want is actually something that you might have to offer in a regulated manner. Is that the right thing or the wrong thing for them? You have to, assess that. But as a platform, if you give the optionality to them, you can look at it this day. You go to interactive brokers, for example, trade some stocks or options. They ask certain questions depending on your risk profile and appetite. And I think with yield, it could be the same interface where the users in a secure environment, knowing that these products actually surpass certain compliance and security thresholds, they can be offered to them. There's not a clear regulation on this today, but if this is allowed, then they would like to be able to select in a subset of products that are relatively tested and secure, and they can have the option to choose something more risky or less risky depending on them. That doesn't necessarily mean the institution has to take the underwriting risk or the governance or other risks, but they have to have some type of guardrails around it to be able to offer it. And I think it's a user acquisition strategy. If you have higher yield, people come to you more. But is it defendable, sustainable? Very questionable these days, and history shows that. So I think you have to act responsibly as an institution, make sure that you can actually provide whatever assets are out there in terms of yield-bearing assets to your users in a responsible manner. Yes, you can be aggressive on your risk, but you cannot be aggressive enough to risk your entire business, so to speak.
What I was gonna say is, in my mind, like on platform balancing like on platform yield with something that's liquid and convenient, like these things are not mutually exclusive. The way I think about it, I think one of the reasons why like products like lending vaults on Morpho have been such a desired like uh, underpinning solution for yield programs is because they offer all these things simultaneously, right? You're able to generate yield that is providing some premium, if you select the right vault with the right risk manager, to Alex's point, that provides some premium above the risk-free rate, but that also provide instant liquidity and the ability of users to withdraw their capital at any point in time, which is obviously a critical UX factor for fintechs, especially on the B2C side. You never want to be explaining to users like why their capital cannot come out of the protocol. And so yeah, I mean, I think like both these things are definitely possible and like are happening at scale today in a lot of fintechs. It's just, I think, a matter of making sure that you are working with like the right protocol partners, the right risk partners, the right chain partners, etc.
From Santiago, do current rating service providers actually check the smart contracts of the products that they recommend? Anyone feel free to jump in.
I guess none of us is working for any like auditors or risk ratings. However, one thing that should be always evaluated as a risk, like there is a protocol risk, and then you see, okay, what is the smart contract, who was the auditor of smart contract. One thing that we are very proud in Morpho, that smart contracts are immutable, meaning that once we passed all the audits, there is no way to change the code. We are not doing any upgrades, meaning that we don't need to run any new additional audits, and there are no like new risk surfaces. So I guess this is like the very basic check that should be done for any new protocol. When was the last upgrade? Is it upgradable overall? What are the existing bug bounties? But from what I know, like Credora is probably the most adopted rating system in DeFi, at least. But it's still pretty new, so we are far from knowing the exact answer.
Yeah, and maybe just to add to that, yeah, completely agree with Credora. I think that's become quite a standard across the industry. I would hope that a lot of these credit rating agencies are seeking support from the credible auditors in the space that are actually doing a lot of this work around smart contracts. Whether it's like Open Zeppelin or Certora or Spearbit. I think that's really important. There are certain standards like Web3 SOC, for example, that have emerged over the last year or so, where that can be plugged in directly into institutional kind of due diligence and these ratings companies. So that's already taking into account technical risk and some of the smart contract aspects that underpin these stablecoins. So there's a ton of resources available to ratings agencies. My hope would just be that they're plugging in the right resources needed to make sound decisions.
As just to add that, so as a yield aggregator, we try to aggregate as much metadata ourselves as possible to kind of risk rate a lot of the protocols we onboard. We have really strict onboarding policies when we're looking at onboarding a new protocol into our stack. We check that all the smart contracts have been audited. We track TVL concentration risk. We even work closely with regulated custodians to track the toxicity levels of a lot of these lending pools. So we use tools like Blockade and Hypernative. And all of that is really part of our stack to make institutionals feel comfortable interacting with this ecosystem, which is very transparent in nature, but you need the right tools to track the sort of risks you're incurring.
So a good question here by Aria from Halborn. What are the biggest attack vectors that the market is not seeing yet from a cybersecurity perspective?
I am not in the cybersecurity space, so I don't really have a direct answer there. But probably what I would say is, if I did, I probably would not disclose it on a public forum like this. But if someone else wants to, go ahead.
Yeah, so I was just going to say, so cybersecurity for us is the forefront of what we do, because obviously we saw what happened last summer with Swissborg and Kiln. And for us, it became a priority to make sure that something like that didn't happen, right? Because at the end of the day, being an API, we're essentially crafting the transaction payload that the user is going to sign to essentially broadcast a certain message to the network. And we have, for example, a cybersecurity posture in place, a program called Shield, where we verify every single transaction before it's signed to make sure that there hasn't been any middleman tampering, which is effectively what happened last summer. We have an in-house white hat hacker that every day tries to penetrate our systems to find where the liabilities are. So that's super important. I think when you interact with TradFi, they're all private ledgers, right? So if something happens, you can do something about it. You can get the funds back somehow. But when you're interacting with a blockchain, like cybersecurity really is the end all be all, and you have to make sure that you really have the best in class posturing in place.
Thanks. So, question from Rodrigo. How do you think the margins of institutional stablecoin yield providers will evolve in the short and medium term? If institutions usually pay a few bips in standard finance, do you think that they will be willing to pay a bit more in this new type of asset, or are they reluctant?
I mean, I'll take a shot at this one. What we have seen is they are willing to pay for trust and simplicity today. So that carries a premium because it's convenient, because it's not unbundled for them. So that's on the short term. I think the margins will stay elevated because of this bundled convenient factor. Medium term, as they build their own, distribution and risk management around these products, it will become near risk-free levels. They'll pay, for a while they'll pay more, but I think building it themselves is always difficult. So they are paying a premium for the convenience. But in the future, it won't last, I think.
I'll just say that, yeah, I think the risk premium is going to be there. It's going to be higher, just given the fact that nothing is bulletproof in this space. Like, we can have as much security, and proactive security management across protocols and contracts, but there's always going to be a little bit of that risk premium that will command, extra bips for sure.
Yeah, I mean, I was just gonna, I'm happy as what we consider Gauntlet like a stablecoin yield provider. Like a lot of what we sell to institutions is stablecoin products to power like earner savings products for their users, and just in terms of how these like commercial agreements typically work, and happy to shed some light on that. I mean, the kind of like flow of funds here is that like Gauntlet is usually the one that's generating revenue via a performance fee on our vaults. That's how we monetize. And obviously, like, to be embedded inside these institutions and access the distribution that they have and the TVL that they can bring to our vaults, like, they need to be compensated for providing that. So typically the way these agreements play out is we are striking some kind of deal with them to pay them, a certain amount of bips or like a revenue share on the performance fees that we are generating from any TVL or capital that is attributable to their integration, right? And I think this creates a really nice, like, synergistic relationship between us and them, where like no one is really paying each other out of pocket. Like, it's very symbiotic in the sense that if it grows, like, both parties are going to do well as a result.
This brings us to 1 o'clock. Maybe we try to squeeze in one more. How transparent will private credit RWA yield strategies more broadly be at the credit profile level, or will it rely on intermediary underwriting? If someone wants to give the final answer.
Yeah, I can take a stab at this one since we do a good bit of this at Gauntlet. But I think it will ultimately depend on the issuer of the RWA. So for RWA issuers that are willing to be very transparent, like we'll use private credit, for example, that are really willing to be very transparent about their loan book and use solutions like Accountable that kind of provide real-time visibility into the credit book and the outstanding loans, et cetera. I think they'll probably get some capital attraction or like premium on top of what you would standardly get from allocators because of that level of transparency. But I also think there's a reason why, like, the Gauntlets of the world exist. And part of that is to do underwriting on these assets that, like, people either aren't capable of doing themselves or don't want to do themselves. et cetera. So I think the answer will be both. I think the nice thing about DeFi, and like you already see this with the way how our vaults are structured on Morpho across different risk profiles, is you can offer all types of different flavors to cater to all types of different allocators, right? And so like if you are an allocator and like it's in your mandate or it's just your strong preference that you need full visibility into all of the positions of everything that you allocate to in real time, yes, that's going to limit your investable universe, but yeah, maybe the trade-off is that like you can sleep better at night because you know that the loans in the private credit instrument you're exposed to are secure. If your mandate is to seek slightly higher yields and you're willing to give up some transparency and trust an intermediate underwriter for that, then that's your prerogative as an allocator. But again, I think the nice thing about DeFi, and one of the things that we try to focus on at Gauntlet, is making sure that no matter who comes to us as an LP, depositor, allocator, like we have a product that meets their reward, risk, and transparency needs.
All right, thanks, Aidan. Huge thanks to Aidan and the rest of the panelists for their time and for their insights. Thank you to everyone for joining. The video, I believe, will be sent to anyone who signed up, the recording, in a week. And if you have any questions, feel free to reach out to any of us. And thanks again for your time.
Thanks, Josh.
Thanks, everyone.
Thanks, guys.
Cheers. Bye-bye.
Thanks, Mike.
Cheers.